If you're a salaried professional in the US, a large portion of your income is already committed before the month even begins. Mortgage or rent, car payment, student loans, insurance premiums, retirement contributions. These predictable monthly payments quietly determine how much flexibility you actually have, and over time, they shape your entire financial structure. For many working professionals, financial stress doesn't come from emergencies. It comes from structure. Most households today operate inside a fixed payment framework. Income arrives on a predictable schedule, and in response, recurring payments live on their own predictable schedule. The system appears stable. Nothing dramatic is happening. Bills are paid. Contributions are made. Accounts remain current. But beneath that stability is a constraint that grows more visible over time. The typical American professional household carries several fixed monthly obligations: mortgage or rent, auto loan or lease, student loan payment, health insurance premium, childcare or tuition, 401k contribution, property taxes, often escrowed monthly, subscription and utility costs. Individually, none of these feel extreme. Collectively, they define the financial boundaries of the household. What makes fixed payments powerful is not just their size, it's their permanence. A mortgage may stretch 30 years. Student loans can extend 10 to 20 years. Auto payments often renew every 4 to 6 years. Health insurance premiums rarely decline. Over time, the baseline expense level becomes embedded in daily life. Career decisions, relocation options, savings rates, and even risk tolerance are shaped around maintaining these commitments. For early career professionals, fixed payments often feel manageable. Income is rising. Promotions are expected. The margin between earnings and obligations appears comfortable. But as careers mature, salary growth tends to slow. In many industries, the largest percentage raises occur in the first decade of employment. Later stages often bring stability rather than acceleration. Meanwhile, fixed payments rarely decrease proportionally. Mortgage payments remain fixed. Insurance premiums often increase. Property taxes adjust upward with home values. Healthcare costs trend higher over time. The result is subtle compression. Income growth slows. Expense structure remains firm. This dynamic is especially visible in households that purchased homes during periods of lower interest rates. The mortgage payment itself may feel manageable, but property taxes and insurance premiums continue to adjust annually. Escrow amounts rise gradually. What felt stable begins to edge upward. Because these increases happen incrementally, they rarely trigger alarm. They simply tighten the monthly margin. The same pattern applies to retirement contributions. Many professionals increase their 401k contributions as income grows, which strengthens long-term security. However, those contributions also reduce present liquidity. Once a higher contribution rate becomes standard, lowering it feels like regression. The fixed structure expands again. The household budget becomes less flexible, not because of mismanagement, but because of accumulated commitments. Over time, this shapes life decisions in ways that aren't immediately obvious. Job mobility becomes more cautious. Relocation becomes more complex. Entrepreneurial risk becomes harder to justify. Time off becomes more difficult to consider. Predictable payments create predictably constrained options. This doesn't imply that fixed payments are negative. In many cases, they reflect responsible planning, home ownership, retirement savings, education investment. These are constructive financial choices. The tension arises when the total fixed structure grows faster than long-term income flexibility. One common example is the dual income household. Two salaries allow qualification for a larger mortgage. The home purchase feels reasonable within current income. But that purchase also assumes the continuation of two incomes. If one career slows, pauses, or shifts direction, the household structure may not easily adjust. The mortgage remains, insurance remains, property taxes remain. The system was built for a specific income configuration. Another example involves lifestyle alignment. As professionals progress in their careers, recurring expenses often scale with income. Larger home, higher insurance coverage, more structured childcare, upgraded vehicles, higher retirement contribution percentages. Each upgrade appears incremental and justified. Yet, over a decade, the cumulative fixed baseline can become significantly higher than intended. At that stage, even modest economic changes, inflation, healthcare cost adjustments, or local tax increases can reduce monthly breathing room. The psychological effect is subtle. Many professionals report feeling financially stable yet not financially flexible. Income may be solid, credit scores strong, retirement accounts growing, and still the ability to pivot feels limited. This is the structural impact of predictable payments. Liquidity becomes secondary to obligation. Savings accounts may exist, but they are often sized relative to fixed expenses. The higher the fixed expense load, the larger the emergency fund required to feel secure. This increases the amount of capital tied up in reserve. Over a long horizon, the structure influences career longevity decisions. Professionals in their 40s and 50s often describe a different relationship with work compared to their early 30s. It's not necessarily dissatisfaction, it's recognition of the monthly baseline that must be maintained. Mortgage, insurance, tuition, retirement catch up contributions. Each one is reasonable in isolation. Together, they create a financial architecture that expects steady income continuity. Inflation amplifies this effect. While some fixed payments remain constant, such as a fixed rate mortgage, principal, and interest, many associated costs do not. Home maintenance costs rise, utility costs fluctuate, healthcare premiums trend upward nationally. Even without major life changes, the total monthly outflow often increases gradually year after year. Because the increases are predictable and incremental, they rarely trigger immediate action. Instead, they become normalized. The long-term result is that the household budget becomes optimized for stability rather than adaptability. There is also a generational layer to this. Millennial and Gen X professionals entered adulthood during periods of rising education costs, housing volatility, and healthcare inflation. Many structured their finances around debt repayment in addition to housing and retirement contributions. As student loan payments resumed in recent years, many households experienced renewed monthly pressure. Not dramatic, but structural. The payments were expected. They were simply reintroduced into an already tight framework. From a broader perspective, predictable monthly payments function like anchors. They provide security and order. They also reduce movement. The goal is not to eliminate fixed payments. That would be unrealistic. Housing, insurance, and retirement contributions are foundational elements of financial stability. But understanding their cumulative structural impact helps explain why many professionals feel financially locked in despite earning stable incomes. Financial flexibility is not determined solely by income level. It is determined by the ratio of fixed obligations to income adaptability. Two households earning the same salary can experience very different levels of freedom depending on their recurring baseline. Over decades, This ratio shapes lifestyle trajectory. It influences whether early retirement feels plausible, whether career transitions feel realistic, whether part time work feels possible, and because these effects unfold slowly, they are often recognized only in hindsight. The structure was built gradually. The constraints were gradual. The realization is gradual. For working professionals navigating mid career years, this awareness becomes increasingly relevant. Income stability remains important, but equally important is recognizing how predictable monthly payments define long term options. In the end, most financial strain is not caused by sudden collapse, it's caused by quiet accumulation. A mortgage signed years ago, an insurance premium adjusted annually, a retirement contribution increased responsibly. Each one logical, each one manageable. Together, they form the framework that shapes the next 10, 20, or 30 years. Predictable payments create predictable lives. The structure provides safety. It also defines the boundaries of movement. And over time, that structure becomes one of the most powerful forces shaping long term financial direction. Not through crisis, but through consistency.